Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Lots of interesting things to talk about this week in the markets and in the commodity markets. And of course, any stocks you'd like me to have a look at, get the stock codes for those ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get into this week's first chart. And starting off with the ASX 200. And well, the ASX 200 briefly touched a new all-time high this week. Is this the start of a new series of records? Before we consider that, there's something happening below the surface you probably should see as well. So I'll talk a bit more about that in a moment. And then over in the US, it's one of the most unusual situations we've seen in years. I'll show you what I mean by that in a minute. But before we get to that, let's start with this latest price action in the ASX 200. So prices hit an all-time high on Thursday before just pulling back a little bit on Friday. It's it's a positive start. Prices making that new all-time high, and we've seen prices continue to re-establish above the moving averages. And this has been a key factor we've been discussing over the last couple of weeks. The moving averages, as you'll see, they also continue to move upwards. So we can now say that it's a clear case of momentum returning to the index. So this is all good. It's exactly what we've been wanting to see. But doesn't mean a bullish trend from like we saw back in mid-2025. Doesn't mean that sort of momentum is coming back in place. And this is where it gets interesting. I'll show you what I mean. Let's jump to the equal weight. So this is ASX 200 index. Let's look at the ASX 200 on an equal weight basis. And when we do this, well, you'll remember the ASX 200 has just hit an all-time high. When we look at the equal weight, it's only a little bit above the recent lows. So in fact, the equal weight is trading at a similar level to where it was last September. So that's nearly no gain in around 5 months. So it's not that the equal weight has been flat for the entire time, but you can see there's been certainly some movement there. But there's been an increasing degree of volatility with prices chopping back and forth within what's really become a large range. You see this large range over the last few months. But it's what's happening in the last couple of weeks that I think we really need to be aware of. So while the ASX 200 is hitting that all-time high, the equal weight, it's consolidating below its moving averages. And as you can see, those moving averages are starting to turn lower. So just to be clear on this, this is not a bearish signal. The equal weight is not broken down. I think the most likely, or I think the more likely scenario is that this is all part of a larger consolidation of that large rally we had off last year's low. But I think it's a case for, at least I think it's a cause for some near-term caution just with this price action we're seeing at the moment. And that's because the majority of ASX 200 stocks are not confirming the all-time high in the index. You can see it through the equal weight. It's not near its all-time high. It's pulled back and it's consolidating below the moving averages. Another thing to keep in mind is that consolidations below declining moving averages, they open a window of vulnerability. It doesn't mean that prices will break down, but there's a fragility to the structure that isn't present when prices are above rising moving averages. So I think that's something important to keep in mind. To disengage this vulnerability, I want to see the equal weight back above its moving averages and then to become established above the moving averages. So get back above, re-establish, and then it's in the upper end of the range, and that can set up the potential for a break higher. But that's the first step, getting back above those moving averages, and that would bring the equal weight more in line with the ASX 200. So that brings up the question, why is the ASX 200 hitting all-time highs when most of the stocks in the ASX 200 aren't participating? And that largely comes down to two stocks, CBA and BHP. And of course, they also happen to be the two biggest stocks. Together they make up around 20% of the ASX 200. Throw in NAB, Westpac, and ANZ, and you've got about 35% of the index. And of course, the other three banks are doing well also. And then, of course, CBA and BHP, they're hitting all-time highs. So a big part of why the ASX 200 has just hit that all-time high. So let's look at these two stocks. Let's start with BHP. We've talked about the bullish trend in materials for the last several months. So BHP's strength and this ongoing trend, it should be no great surprise. This is something which has been discussed. There was materials generally broke out from a big ranging period, and they've been strengthening. So we've got that ongoing trend in BHP. Now this is a sort of trend that I'd want to stay on, and I'd be using a wide trailing stop to do so. Nothing here suggests that it's about to end, but from a near-term perspective, just look where the 50-day moving average is, look where the price is. So it is getting somewhat stretched above its 50-day moving average. And when a market or a price gets stretched above the moving average, it just increases that prospect of either a pause or some sort of a pullback while the moving average catches up. And with many ASX 200 stocks currently not contributing to the index's rally, a pullback in BHP, well, that would then make it harder for this week's all-time high to become a series of new all-time highs in the near term. And then we've got CBA, and we've got this powerful rally off the low, and that disengages the downward momentum that had been building below the moving averages in recent months. And I think the rally, it does set up the conditions for a new trending phase, a new upward trending phase in CBA, and also in the banks generally. But it's also keep in mind that it's quickly run from below the moving averages to above the moving averages. And when this happens, prices often pause to consolidate those gains, just lets the moving averages catch up. If we get to get a few weeks of pause or somewhat of pullback, that just relieves that near-term overbought situation. And it would also, and should we get some consolidation above the moving averages, it also, of course, lets CBA re-establish itself above the moving averages, which is another positive for CBA and the market generally. So as I said with BHP, with so many ASX 200 stocks currently not contributing to the index's rally, a pullback in either BHP or CBA would probably make it harder for the ASX 200 to embark on a new series of all-time highs just in the near term. Briefly coming back to the ASX 200, just to be clear on all this, I think the play here, I think it's staying long stocks. It's staying long stocks. It's letting winning positions run. The ASX 200, this is a bullish structure. So don't get me wrong with this. It's a bullish structure that just may need to pause in the near term. And I think there's a high likelihood we see higher levels in the coming months. But at the moment, we don't have a broad-based rally. We have a broad-based consolidation. That's what we're seeing when we look at the ASX 200 equal weight. I won't be surprised to see the index pause in the near term, but an overall a bullish structure heading into the middle section of the year. Now we're going to jump over to the US market now and cover the S&P 500 and the like. Before we do that, if you're getting some value, please click that like button. It helps me heaps when you click the like button because YouTube shows other people the video. And that makes a big difference for me. So please do that. Click the like button. Tell me what you think. Do you think we're off to a series of new all-time highs? Is it a pause or is it something else? Tell me what you think. Always interesting to see what others are thinking in that comment section. All right, so let's go over to the S&P 500 next. So it's another week, and still the S&P 500 remains stuck in this tight range. The market has been trading at, well, market is trading at the same level as it was back in late October, but it's really only been in the last 7 weeks, just this period in here, really only in the last 7 weeks that the range has really started to tighten up. On its own, there's nothing alarming about this price structure. The S&P 500, it has this long established upward trend, and prices are currently consolidating pretty much along and into the moving averages. Again, the 50 and 100-day moving averages. It's not the sort of price action that, well, it actually is. It is the sort of price action that often appears within a bullish trend, and we see this sort of price action when prices pause to consolidate. And much of the time, it resolves with higher prices. And the trend is even clearer when we look at the S&P 500 on an equal weight basis. So let's jump over the S&P 500 equal weight, and you can see the upward trend even clearer, particularly in the over the last few months. While the S&P 500 index has been range bound, we've had good trending conditions in the equal weight, and you see this long-running series of rising lows, rising highs, and moving averages trending higher. Prices are sitting just below. If you look where we are now, prices are sitting just below an all-time high, so it's a textbook uptrend. And the key point to make about strength in the equal weight is that it's a clear indication of broad participation in stocks. In fact, participation has been expanding, and there's actually an increasing number of stocks above their 100-day moving average. So that's a positive sign. I saw an interesting graph today. It turned up on my X feed. I'll give you a quick look at it. It's this one here. So what this is doing, it's showing the number of S&P 500 stocks that are outperforming the index. You can see the years down on the bottom axis, and then in white, that's where we currently are for this year. So it's showing the number of stocks outperforming the S&P 500 index. Of course, there's 500 stocks in the index, and as it stands, about 2/3 of those 500 stocks are beating the S&P 500. They're beating the index. That's the biggest proportion of stocks outperforming the index since the data on this began back in 1986. You can see where things have been previously. So that's a lot of stocks outperforming. So again, it's another sign that this is a broad-based bull market, and it's a broad-based bull market which is typically associated with good investment conditions. So why is the S&P 500 stuck in a range when we've got all this outperformance happening within the index? We've got the equal weight charging off and just below all-time highs. Why is the index struggling to move higher? As we discussed as we've been discussing in recent strategy sessions, much of the issue comes down to the NASDAQ. So it comes down to tech. We've been tracking the weakness in this structure. So this is a NASDAQ 100, and we've been tracking the weakness in this structure for a couple of weeks, and it hasn't improved this week. Prices continue to have their daily close below the 100-day moving average. So the blue line, that's a 100-day moving average, so 50 above that. And the moving averages, they continue to turn lower. The NASDAQ hasn't broken down at this point, but the longer it spends below the moving average, below the 100-day moving average, the greater the risk of a breakdown. I think this week's low is particularly important. You can just see where the cursor is here. I want to keep a close eye on this. Prices briefly broke below the early February low this week when we made this new low. So there's the early February low. Just this week, we got a marginally new low below it. So we got a brief break below the early Feb low, but then prices quickly rebounded. So that's a sign of the dip being bought. But I think this low needs to hold. I think a retest of the low, prices were to come down, retest the low. I think that could spark follow-through selling, which could then bring the November low into focus. You get a market which then has more lower lows, and we're looking at the November low, and again, it continues to potentially weaken the Nasdaq structure. I think that I think getting a foothold, at current levels, and then getting back above the moving averages, I think that's critical in disengaging the vulnerability that is currently setting up in the Nasdaq below the moving averages. The other point of concern in the US market is the big seven stocks, the Magnificent Seven. This is the ETF which tracks the Mag 7, and well, this hit a 5-month low on Tuesday, and the price structure, well, it's weakened further. There's a clear series of lower lows and lower highs, and that's and also prices becoming more established below these moving averages. Moving averages are rolling over, prices are becoming more established below them. So it's currently a case that the rallies are being sold. So we've got this unusual situation where there's strength and broad-based participation across large sections of the market, but at the same time, we've got this technical structure, this weakening technical structure in a key driver of the bull market. So it's not the sort of price action we'd expect to see when you've got so many parts of the market doing well. The popular story is that it's rotation out of tech, and maybe it's as simple as that. But I don't think we should ignore the non-confirmation that we're seeing in the Magnificent Seven and in the Nasdaq. The best situations in markets are when everything's lining up, and when you got a couple of major areas out of step, it always is cause for having a look and being aware and having plans to act should things deteriorate. At the very least, I think it's a sign of greater instability in the market at this point in time. Just coming back to the S&P for a moment. Now, look, I'm not in the business of predicting tops. I'm not going to start now. I think betting against a trend is betting against the odds. I think it's a losing game. If you've got an upward trend, that's a path of least resistance. As it stands, this bull market remains intact. I believe the correct approach is to continue holding stocks in uptrends and having those predetermined exit points should things change. But I also think it's important to recognize we don't have bullish confirmation from tech. And I believe that warrants some extra caution in this market at the moment. For me, that simply means, as I say, holding winning positions, giving them room to move, having that plan to sell stocks that aren't working, be they tech or something else. If something's not working, I don't want to hang in there and hold on and hope it comes good. I just want to get it out of the portfolio. And then also holding a little bit of extra cash until we get a clearer picture. The picture will clear at some point in one way or another, and until that clearer picture comes along, I'm happy to be a little bit more cautious and conservative. But as I say, staying long what's working. Okay, so let's jump to the US small caps now. We've got the local small caps, the commodities to go through: copper, gold, oil, silver, uranium. Lots of interesting things happening there, particularly with oil this week. And but of course, that wraps up the free section. If you're not a Strategy Session member, there's a link below. Click that. Come on in. Doesn't cost very much. We're going to go through a whole heap of interesting things. And yeah, as I say, it doesn't cost you very much to be a part of it. So think about doing that. All right, so let's start with the Russell, the US small caps.